What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. So I'm still in the Dominican Republic at the Life 180 retreat. It's the final day. I'm actually heading out to the airport in about an hour and a half. I wanted to shoot one last piece of content while I'm here. So it's been just an awesome trip. But I saw a lot of social media never provides a shortage of interesting things to break down. And today we're going to break down another hit piece on infinite banking. Quite frankly, I don't think it was a very useful article. It didn't really say anything bad about infinite banking. And that's the problem I have with this kind of stuff. It's not that people disagree with infinite banking or, that, it doesn't fit in with their finances and goals and their philosophy. Like that's fine. I don't care. Like infinite banking, dividend paying whole life insurance, definitely not for everybody. But in order to come to the conclusion on whether or not something makes sense for your goals, your situation, and that's going to help you accelerate the wealth building process, you have to have the facts. You have to know what your options are. You have to know how those options work. And I'm a big believer in letting people make their own decisions. Like, stop trying to force stuff onto people by making something sound bad so that your stuff sounds better. That's not productive. It doesn't serve people. It's really, really frustrating to see this kind of stuff, especially like this article we're going to break down. Like I said, didn't really say anything actually bad, like factually, with regards to how infinite banking actually works. So I just want you guys to know how these things can benefit you. Maybe it makes sense, maybe not. As someone that implements the infinite banking concept myself, I know firsthand how powerful it is. I have 2 policies right now, and I actively use them, and they can be incredibly powerful. And they can create such the policies, that is, to implement infinite banking, can give us such a strong and powerful financial foundation. So it's just interesting when I see these hit pieces. Like I said, it's not for everybody, but let's make sure that we're having a productive conversation. We're hearing both sides of the story so that you can make the best decision for yourself, right? So let's have some fun. Let me share my screen here. And this post, or this article, was shared on a post that I commented on, and I was going back and forth a little bit in the comment section on LinkedIn. And there was an agent talking about how you can become your own bank with an IUL, which I do not recommend at all, guys. I'm not a fan of IUL whatsoever. I think it's a pretty pointless product because you can get upside potential, downside protection in the market with a whole life product and avoid all the problems that come with IUL, especially later on down the road. But IUL can be pretty risky, or like implementing infinite banking with IUL can be pretty risky. And we were going back and forth, and then this article was shared, and it was just not productive in my opinion. So let's just break it down here. So we love our TikTok, especially cooking segments, blah, blah, blah. TikTok users are served up an endless number of videos promoting infinite banking, which can be a problem. Like social media, especially TikTok right now, about like all the content around becoming your own bank and infinite banking and stuff. Man, there's some pretty crazy stuff on these platforms right now. So please be careful. Viewers are inundated with suggestions that they become their own bank by purchasing a life insurance policy, usually a whole life insurance contract. It's interesting that he brings up whole life insurance for this, because most of the content that I see on TikTok and these Instagram reels and stuff, like the short form content, it's usually talking about IUL. I don't see a ton of content talking about whole life. I don't know. Either way, I mean, there's probably some pretty interesting stuff about whole life on there as well. But a lot of the stuff I see, it's always about IUL. The content creators claim that lots of super rich people are their own banks because of how they use their whole life insurance policies. I mean, there is definitely a history of wealthy people using their policies. J.C. Penney, and then you got Ray Kroc with McDonald's and stuff like that. Again, that doesn't mean that it's still right for you just because the super rich are using it. And but it's something to pay attention to, especially like we look at major, like huge elite level financial institutions, the big banks. Like, where do they put their money? A lot of the times it's like their tier 1 capital. They put billions and billions and billions of dollars into cash value whole life insurance. So that's something to pay attention to, at least. This simply is not true. You could probably make an argument for both. There's super rich people that use their whole life insurance policies. There's super rich people that probably don't. Whatever. I don't think that's a really useful part of the conversation. And adopting infinite banking as described on TikTok and on other platforms likely brings more financial risk than benefits. I would actually agree with that to a certain extent. The content that I've seen, especially like when the post that I commented on that led to this article being shared, they were talking about becoming your own bank with an IUL, which can absolutely bring way more financial risk than the benefits. So I actually would agree with that. All right, what is infinite banking? It's a strategy whereby the ability to take withdrawals and loans from a cash value policy is exploited. Okay, this is not the right word for this. And again, this is part of the problem I have with this kind of stuff, man. Like, you're not exploiting anything. We're utilizing the cash value in our policy to build wealth like we normally would, but exploiting just makes it sound like something nefarious is going on, something really bad. It's just, I don't like that kind of stuff. It's not productive. Exploited in a manner that a policyholder is led to believe that they can take frequent distributions and make occasional premium payments whenever they feel the need to do so. So this is interesting. Earlier, he said usually a whole life contract within the content of infinite banking on these social media platforms, but now he's talking about frequent distributions and making occasional premium payments. So typically, when we're talking about like occasional premium payments, you're talking about the flexibility of a universal life product, which in this case, we're talking about like IULs. So he's kind of flip-flopping here a little bit. The frequent distributions, so probably talking about like tax-free retirement income, or utilizing the policy to, maybe purchase a vehicle, purchase a real estate investment property, something like that. It's not really a distribution though. When you hear distribution, I think of like taking a distribution from a 401k or a retirement plan or something like that. We're not doing that with infinite banking. We're taking policy loans, right? So we're borrowing against our policy, and then we're building wealth with it, how we normally would. That's not a distribution. That's a policy loans. Very, very different. There's often there can be penalties and tax implications with distributions. With policy loans, that's not the case. So just to make sure we're being clear on that. The premise is that the money in a cash value life insurance policy grows tax deferred, which it does, unlike in a bank account. So why not keep most or all of your money in a policy and access it like you would a bank, replenishing as needed? No, you do not put most or all of your money in a policy. Look, even though I'm going to switch this up just a little bit and then we'll go back. All right. Even though I'm a big fan of an advocate of infinite banking, I use it in my life and it's really, really powerful. I would never tell somebody to put most or all of your money in a policy. Like I've seen content where people are talking about running all of your income through your policy and then borrowing against it to pay your expenses and stuff. Guys, that is not what we are doing. That is not what infinite banking is supposed to be used for, in my personal opinion. That takes a lot of management, and that's not in alignment, I think, with what the core benefits are of infinite banking, which is to allow us to accelerate the wealth building process, where we're able to leverage somebody else's money. Our money continues to compound uninterrupted. We're able to build our wealth. We're able to eliminate lost opportunity costs, things like that. That's what we're really trying to do with infinite banking. It's not running your entire paycheck into your policy and then paying off your monthly expenses. I suppose you could do that, and maybe in some situations it makes sense, but that's just that's not how I utilize it. It's not how I recommend clients use it, or my audience. So, and then let's see. The other thing I was going to say about that, and we'll just bring this back up real quick though, is that I moved a significant portion of my safe money, my opportunity money, my emergency money into these policies, but I still have money in the bank. I still have money in other investment opportunities. So you don't move all of your money into these policies. So let's see. Whole life policies are the favorite policy type for promoters of infinite banking for two main reasons. It's actually, I think there's a lot more IUL content out there, like people pushing IUL for this kind of stuff than whole life, unfortunately. But whole life, like dividend paying whole life insurance, just happens to be the perfect vehicle in order to implement something like the infinite banking concept. But his two main reasons are pretty interesting. It's like, this is why this kind of stuff is just completely useless and unproductive. First, the salesperson. So now we're a salesperson. Does not have to have a securities license to sell whole life. Really? So just a state insurance license. Okay. Well, I could tell you when I got into this business, I like it, my one of my main reasons for getting into it was not, oh, I don't want to get a securities license. What on earth does that have to do with infinite banking? Like where are you trying to go with that? I don't even know where to go with that. That's such a useless thing to say. This means that there is a lot less regulatory oversight on sales practices, including compliance review of selling language, et cetera, et cetera. I would agree with this. Again, I don't know what this has to do with infinite banking, but let's break this down really quick. I do agree that there needs to be a significant amount of more of accountability. Like some of the stuff that I see posted and shared is just, I don't know how some of this stuff is legal. That some of the articles I've broken down and comments and stuff, it's like people saying you can never lose money in an IUL. It is just unbelievable. I guess I can kind of see where he's going with this. I just don't know what it has to do with infinite banking. For those professional life insurance producers who have securities licenses, a background check can be performed. Okay, whatever. Second, whole life insurance policies are expensive. So let's stop there really quick, and then we'll get into the next part of that statement. So here's the issue with saying something is expensive. It's something being cheap and expensive is very, very relative. All right. So should we like everything we buy? Should we always buy the cheapest? So if I have, let's say I want to get coaching on something, marketing, because I have a marketing business as well. And I really want to make sure I get results. Well, should I go with one coach just because he's the cheapest? Or should I go with a more expensive coach because he actually gets the results? And this coach gets far more results than the other coach. Well, the other one's cheaper. So should I just do that? No, you have to weigh the pros and cons of both. So like when you say it's expensive compared to what? And what are we getting? Like it makes it sound like we're not getting enough value for the money that we are contributing, which I would argue to the end of the earth that we absolutely do. We get way more benefit with our money in these types of policies than a lot of other types of financial products because it solves so many problems with the same amount of dollars. Like the dollars we put in, it solves the death benefit, protecting our loved ones. We have the living benefits. We have the uninterrupted tax-free compound growth. We have the liquidity, the safety, so many, opportunity fund, emergency fund. Like it sets us up. It solves so many problems with one financial vehicle. And I just, so when you say it's expensive compared to what are we talking? Like it comes down to the value that we're getting for our money. So to say it's just expensive is, whatever. Again, this is a hit piece, so I'm not really surprised. They pay proportionally significant upfront commissions. So this is always a fun conversation. Like when people bring up commissions, like making money is a bad thing. Here's the thing, guys. If you have a problem with people making commissions on financial products, never buy another financial product ever again because people make commissions and it's okay. The question is, what is what they are providing going to give you the benefits you're looking for? Is it going to solve the problems that you are seeking solutions for? And here's the thing, like you don't pay life insurance agents anything. The life insurance company does. And that is baked into, like when you look at your illustration on a whole life policy, I mean, that's net of commissions, fees, et cetera. So the commissions are not a problem, not to mention the way that we structure, at least that I structure these, is how I structured my own policies. The way that we design them for the infinite banking concept, so we get high cash value in the first year. That significantly lowers the commission of the life insurance agent. We take a pretty big hit on our commission when we design it for high cash value for people. And that's okay. To me, it needs to be designed in the way that's going to benefit the client the most, regardless of how that impacts commission. Okay. So, but the other side of this, like a lot of the times this conversation, this argument about commissions, like, oh, whole life pays really high commissions. Okay. So does like assets under management, for example, like that 1% to 2% fee that advisors get. How much commission are you earning over the lifetime of managing that account? Not to mention that 1% to 2% compounds as the account grows. So if you start out with 100,000 and then let's say in 10 years it's 200,000, all right, the advisor is still making that 1% to 2%, but now it's on 200,000. So his commission is increasing throughout the life of managing that account. That is not the case with life insurance. We get upfront, a large commission up front, like for the first year. But then after that, it trails off. We get maybe 1 or 2% for every company's a little bit different, 5 years, 7 years, 10 years. After that, it's done. So, again, tell the whole story here. You're just saying that it's expensive and there's high commissions compared to what? So gotta know the whole story here, guys. A primary reason whole life is expensive is that the death benefit is usually guaranteed as long as the premiums are paid as laid out by the insurance company in the policy contract. This is halfway true. I mean, the whole life policies do come with guarantees. So obviously we're going to pay a little bit more for that, I guess. But the main reason that whole life is more expensive in the beginning as compared to something like an IUL, which is far more expensive later on down the road from a cost of insurance standpoint, whole life insurance, the costs are guaranteed level throughout the entire policy. So that's why it's more expensive in the beginning, because it's level. It's making up for the cost later on down the road as well. I'm not going to go down that rabbit hole. I think I did an entire video on this. If not, I'll link it down in the description once I have it done. But basically, that's why whole life is more expensive in the beginning. But from a cost of insurance standpoint, it's actually super cheap as you get older because the costs are level. They're not going up every single year like they do. It's not going up every single year like it does in an IUL. So just to clarify that, the guaranteed death benefit makes whole life suitable for estate planning, which is true, where liquidity is needed to pay transfer taxes or to see care of family members left behind. That's true. Whole life would not be a professional insurance producer's recommendation as a top choice for accumulation. It's just one of the weaknesses of infinite banking. You didn't say, you didn't give one weakness about infinite banking at all. That's why I don't like stuff like this. I haven't seen anything that breaks down infinite banking in a productive way that would expose any type of weakness. Are there weaknesses? Sure. I mean, and we could talk about that, but you didn't say anything here. All you're talking about is the securities license and the commissions and it's expensive and whatnot. That's not productive. So, and as far as being an accumulation vehicle, again, compared to what? So typically these whole life policies designed the way that we design them for infinite banking, they're going to get that 3.5% to 5% tax-free compound growth for the life of the policy. I think that's pretty good for a savings vehicle, not an investment. When I see words like accumulation, I often see people like comparing whole life to investment vehicles. You cannot do that. It's not an investment. It has nothing to do with the stock market or anything like that. But can it be a fantastic accumulation vehicle? I think it can be because of that tax-free, uninterrupted tax-free compound growth. Dude, guys, when you give compound interest 30, 40 years to do its thing, you'd be amazed at the numbers. The numbers will blow your mind. You don't need a super high rate of return in order to build wealth. With that said, we don't set these policies up for the 3.5%, 5%. That is a bonus, in my opinion. Because we get all the other benefits as well. But I think about how am I going to use the policy to go and build wealth to get those higher rates of return. I just did a video on this where I closed out one of my very first investments using my policy, and it was like a 40%, almost a 40% annualized rate of return. Like on the actual deal, it was like 6.5 within 10 weeks. I flipped a piece of heavy equipment. And, 40% annualized rate of return, 6.5 in 10 weeks, like that's pretty good. And what did it cost me? It just cost me a little bit of simple interest in order to leverage my policy and borrow against it. I put the money back into the policy. And then when the next opportunity presents itself, now I can take advantage of it. But the whole time I had my money in that investment, my policy was getting that 3.5 to 5% tax-free compound growth. So from an accumulation standpoint, I feel like this makes whatever you would say is more appropriate for accumulation. A dividend paying whole life insurance policy, implementing the infinite banking concept can make it even better because of how these policies work. All right, let's continue. All right, the foundation is sound. The future income policy feature at the heart of infinite banking. No. Okay. So it's actually a major reason policyholders purchase cash value policies. Unfortunately, that is true. Well, I don't want to say unfortunately. The reason I say unfortunately is because the way that these things are sold, particularly IULs, they show you this just ridiculous amounts of and highly unrealistic amount of tax-free retirement income that you're going to get starting at 65, and it's never going to end. You're going to get that amount for life. Guys, when you start taking policy loans in retirement for income, that's where, when you have an IUL, that's where you can really get into trouble. That's where you really inject just a ridiculous amount of risk into the policy. So here's the thing, to clarify, the future income policy feature, number one, that sounds like something you'd put on an IUL. I've seen like these guaranteed lifetime income riders or whatever. I've never seen that on a whole life policy. Maybe it exists, I don't know. But I'll tell you this, we don't set these policies up for the income later on. Can it provide you a really good supplemental income stream in retirement and act as a really good volatility buffer as well? Absolutely. Not downplaying that. That's not usually why you set these policies up if you're going to be implementing infinite banking. Infinite banking is about utilizing the policy to build wealth. For me, that's the heart of infinite banking. It's not future income policy. All right. So I guess I'm agreeing with him in this particular case where that's not how these things are supposed to be done. All right. By overfunding a cash value policy and purchasing as little death benefit as regulations allow, that's correct. That's usually how you want to design policies if you can. Everybody's different though. A policyholder can leverage the tax-free buildup of cash value. Later, usually 15 or more years in the future, distributions can be taken from the policy to provide an income stream to the policyholder. Okay, so if you are going to be using your policy for income, then waiting for the policy to mature, to get more efficient, I'm talking about whole life here, not IUL, then yes, then this is pretty accurate. I mean, you want to give the policy enough time to become more efficient and grow, right? But again, the distributions, I don't like this word because it implies tax implications and potential penalties and stuff like that. So typically when you're taking income from a policy, it's in the form of a policy loan. What I like to do though, I don't do this right now, but my plan would be is to turn my dividend into, I guess, a tax-free distribution. All right. Because when you take your dividends in cash, it's tax-free up until the premium you paid into, up to your principal basis, whatever. All right. It's tax-free up until that point. And then you could switch to taking policy loans. That's how I plan on using my policy for supplemental income. All right. But yeah, I just want to clarify some of the language here. This money can be used for retirement, buy a second home, pay for a wedding, policy can go untouched, which, I mean, if you're setting it up for infinite banking, you don't want to just leave your policy and not utilize it to build wealth. I mean, that's why you set the policy up, is to implement the infinite banking concept, which is to go out and build wealth like you normally would, utilizing the policy. All right, built up cash value, any death benefit can be passed on to heirs income tax free. That's correct. Usually a life insurance company will permit withdrawals of policy loans up to 90% of a policy's cash surrender value. That is correct. All right, this strategy works best when at the time the policy is purchased, the policyholder has a plan for when distributions will occur and funds the policy accordingly. Okay, yes, you definitely want to map this out, run some illustrations showing income being taken, things like that, so you can plan accordingly. Just remember, guys, illustrations are just that, illustrations. Life doesn't happen on an illustration. So you know what? I'm not going to go down that rabbit hole. That's a whole other conversation. For instance, if distributions will be in 15 years and not in 25 years, I think the battery just, shoot, hang on, guys. I think my internet may have just gone down. Give me 1 second. Okay, sorry about that, guys. I think we're good. The internet's been a little rocky here in the Dominican Republic, as to be expected, but hasn't been too bad. So let's continue, though. For instance, if distribution would be in 15 years, not 25 years, policyholder may want to accelerate the amount or timing of premiums. So again, this is all language talking about how an IUL works, because you can, the timing of premiums, because universal life products have flexibility with their premium payments. I don't think that's actually a benefit. I think that can really hurt people, because if you take advantage of that flexibility and you skip premium payments, that can have a very negative impact on the performance of the policy. Got to be really careful with that. All right. So that more money is growing tax-free within the policy, early distributions can be supported. So this all comes down to how you set the policy up in the first place, like how you fund it. So even if unplanned distributions are needed for liquidity emergencies, these can be accomplished with usually only a little change to future funding and in an established future distribution strategy to return the policy to where, okay, no, with only a little change to future funding. No, when you take a policy loan for an emergency, I mean, hopefully you'd still be able to make the premium payment while you pay the policy loan back. That way, because when you take a policy loan, guys, it's not a structured loan. Like there's no repayment schedule or anything because it's collateralized by the death benefit. So you could pay that policy loan back in the event of an emergency as you see fit, as you're able to pay that policy loan back. But I would say you absolutely still want to make your premium payment to make sure that you're funding the policy as what you set it up to be and illustrate it, right? Because if you don't, then that can negatively impact the long-term growth of the policy. All right. Not the end of the world, and how we do like whole life policies is we have, you have the base premium and then paid up additions. The base premium is the minimum amount that you have to pay every year, but then the paid up additions is at your discretion. So you can put, like in my example, for my policy, I front loaded for the first year, and then every year after is going to be $25,000 into the policy. I think 6,200 of that is my base, and then everything else up until 25,000 is paid up additions, which is at my discretion. So if I fall on hard times and I can't make the full 25,000, I'm not on the hook for it. I'm only on the hook for the 6,200. So I do have some flexibility there, and that's different than not funding an IUL properly, because even if I don't put the paid up additions into my policy 1 year, I don't run the risk of I don't increase the risk of my policy lapsing, because whole life policies are guaranteed to grow every single year. And as opposed to IULs, which is based on stock market performance and call options and all this stuff. So there's you have that flexibility. You just want to try to make sure you stick to the original plan if possible. That's all. All right, let's finish up here. All right. Oh, and also when he says return the policy to where it is still, where it's still meeting the original planning goals, like when you pay the policy loan back, guys, because you borrow the life insurance company's money, that doesn't impact the growth of your policy, right? Again, as long as you're making the premium payments too, obviously that would impact it. But when you pay the policy loan back, let's say it takes you 5 years to pay the policy loan back. Well, your policy continued to grow as if you never touched the money in the first place, because you borrowed the life insurance company's money. You didn't use your own. So all you're doing here, though, when you pay that policy loan back, is you're restoring the cash value that you can now borrow against. Again, that's really what you're doing, but it doesn't impact the growth of the policy. Generally, less expensive policies have more potential for cash value growth. Yes. So when you say less expensive, I think he's talking about like the lower death benefit. The lower the death benefit, the less expensive the policy is. Pretty sure that's what he's talking about. If that's the case, that is true. Policies such as variable universal life, and IUL are typically preferred, over whole life versions. It's just interesting because in the very beginning, he said usually a whole life policy is like what's promoted. Now he's saying UL products are preferred over whole life, like, which they shouldn't be. Research the history of universal life, guys. Universal life, variable universal life, index universal life. They're all built on the same chassis, annual renewable term. It's not pretty. It does not have a good resume. Universal life, complete failure. Variable universal life, complete failure. So many people got hurt by those things, and I can only imagine, just based on what I see, it's gonna be a repeat with IULs. So I don't know why people roll the dice with their financial future with those products. All right, the headaches. Life insurance company is not a bank. That's true. Life insurance company or life insurance policy is not a bank account. That is true. We're essentially setting up our own private banking system here because we're able to leverage the policy. Like, we're able to borrow against it and not use our own money. So we continue to get that uninterrupted compound growth. And we use it like a bank where we can finance major purchases in our lives and eliminate that lost opportunity cost. I've done multiple videos on this, on why I use my I used my policy to purchase my vehicle. I think it's the best way to buy a vehicle. I will link that down below. Make sure you check it out. look at this. Infinite banking seeks to abuse the distribution capabilities of a cash value policy. Look at that. Suggesting frequent unplanned withdrawals are not problematic. Okay, they definitely are with IUL, because if you rack up too big of a loan balance and you get a 0 year, where's that interest coming from? Well, it's coming from the cash value. And if you have borrowed too much against your policy to where the cash value left in the policy can't cover the interest, cost, fees, etc., you're in trouble. You better have some cash on hand to make sure your policy doesn't lapse. With a whole life policy, that's not a problem. So let's see, unplanned, again, withdrawals. We're not taking withdrawals. We are taking policy loans. If you take withdrawals, then yeah, that will impact your policy over the long run. Absolutely. But we don't take withdrawals. So I don't know why you're bringing this kind of stuff up. What is the harm? The damage is most evident if the policy eventually lapses. I already talked about that. And all the previously tax-free policy loans are then taxable at ordinary rates. That is correct. That's much more likely to happen with an IUL, very unlikely to happen with a whole life. Like a whole life policy, you have to be very irresponsible with your whole life policy to get it to lapse. If you're not managing the policy loan and you're not at least paying the interest every single year, then yes, you can lapse a whole life policy. But if that's what you're going to do, or you think that's a possibility of you doing that, you probably shouldn't set the policy up in the first place. So a solution to this might be for the policyholder to step in, make additional premium payments. I guess you'd have to pay the loan back is what you would have to do. Like if the interest is more than what the cash value can cover, then you'd have to pay that policy loan in order to at least cover the interest. All right. And also what he's talking about is like when you get older and your cost of insurance has skyrocketed on these IULs because it's built on annual renewable term and you haven't managed your net amount at risk, yeah, you might be required to make additional premium payments in order to cover that cost of insurance. I've done tons of videos on this, guys. Please check them out. I'll link it down below. Do your research on this stuff. Either way, this decision is most likely to arise in future years, correct? Yep, right here. When the policyholder is older, even elderly. Absolutely, 100% agree. I see stories like this all the time. It is so sad. And that's why I have such a problem with the way that IULs are marketed and the way that they're sold. It's so misleading. It's so risky. And people don't find out until they're old, until they're older. And it's really sad. It may be that policyholder will not be in a financial position to pay additional premium, giving them no choice but to lapse the policy. Absolutely correct. It's really sad. Next, whole life and other cash value policies almost always have surrender charges. Taking withdrawals before those surrender charges have expired in 15 to 20 years. Wrong. Means the policyholder encounters that charge. Okay, with IUL and universal life products, absolutely. With whole life, we can set these policies up to have extremely high cash value in the first year. I think you could do that with IUL also, but there's definitely a cost to that. So again, make sure you do your research on that. But in whole life policies, I mean, my first policy is set to to break even by year 4. My second policy breaks even year 5. So what are you talking about? Like 15 to 20 years? I don't. You're talking about probably a traditional whole life policy, not designed for cash value, 100% base premium. It takes 20 years to break even. I guess that's what he's talking about. But infinite banking claims tend to leave out the part about penalties for accessing the policy at any time in the near future. This is just flat out wrong. What penalty? There's no penalty for accessing taking a policy loan. What are you talking about? There's no penalties. There's interest that you pay, a simple interest. But I've taken multiple policy loans. Like I took my first policy loan within 2 weeks of setting up my policy. I didn't have a penalty. What are you talking about? This is just terrible information right here. This is the frustrating part of the job here, guys. But this is why I do these videos, because I want you to know, like crap like this is just not true. Maybe there's penalties for IULs. Like penalties for access. But see, you know what? I'm not even going to go there with IUL though, even though I love to pick on IUL because it's trash for the most part. But even with an IUL, you're still taking a policy loan. There's no penalty for that. So wrong. In addition to taking distributions from a whole life policy, eliminates the guarantee that the policy will remain in force as designed. No. What are you talking about? Maybe there's just not enough clarity on what, like, he's not going into enough detail about what he's trying to say, because like saying something like that is just absolutely ridiculous. So if you start taking policy loans, on a whole life product, in a whole life policy for tax-free retirement income later on down the road, and you over leverage the policy, you take out way too much, and you didn't fund it properly, or enough, I should say, for the amount of income that you want to take, and you haven't given it enough time to mature, then you could run into trouble. But that does not change the guarantee. Like, the policy is just going to do what it does regardless. You have those guarantees, but it's how you utilize the policy that's going to dictate whether or not the policy lapses. But guys, like, as long as you're responsible with your whole life policy, and you're going to be fine. Like, this is just very, very bizarre stuff. Distributions are not the only culprit. Loans, yes, he's not even taking. When he's saying distributions, he's talking about withdrawals, which you just don't do. And guys, also, if you want to eliminate the risk of the policy, whole life policy lapsing due to policy loans, just change your dividend to paid in cash. That's it. That's literally all you have to do. Take that up until your premium payment amount, your principal base, and then start taking policy loans. You could do that as well. Distribution, let's see, loans have interest assessed, and this loan builds up the loan balance. So the policy loan, you're charged simple interest, but it can compound against you if you don't pay that interest. So that is accurate. But when you're implementing infinite banking, you always want to pay back the policy loan. Always. Would you not pay back a regular, a loan to a traditional bank? Of course you wouldn't. Like, that's going to hurt your credit. There's financial consequences to it. So why would you do that to your own private banking system? That doesn't make any sense. So you always pay the loan back. Many whole life insurance companies charge 8% interest on their loans. No, they don't. The max they'll usually charge is 8%. My policy loan rate right now is 5.5%. So what are you talking about? Banks, of course, do not charge interest for withdrawals. Okay, but you also lose the interest that you could have earned by making that withdrawal. That's part of the infinite banking concept and why it's so powerful. All right. When you take a withdrawal from, let's say you're earning 1% in your bank accounts, which is pathetic, obviously, but let's say you got the 1%, which you have to pay tax on that as well. Okay, let's not forget that part. But let's say you got $100,000 in there, and you take that. Let's say you take out $50,000. Okay, well, now you're only earning interest on $50,000. There's lost opportunity cost there, because that $50,000 that you took the withdrawal of is no longer earning interest for you. With a whole life policy, when we're not making withdrawals, we're taking policy loans, doing what we need to do, build wealth, take care of the emergency, etc. While we do that, our money is getting uninterrupted compound growth at 3 to 5% tax-free. It's usually what these policies do, 3.5%, 5%. And we pay a little bit of simple interest in order to have that environment. When you run the actual numbers, you see why it makes sense. Compound interest is so much more powerful than simple interest, right? So it makes sense to pay a little bit of interest to continue to get that uninterrupted compound growth while we build wealth over here. Okay. So no, there's not an interest charge, like a direct interest charge from the bank, all right, to make the withdrawal, but you're losing the interest that you could have earned as well. So keep that in mind. The question least addressed in infinite banking claims is, who is tracking all the distributions of unplanned premium payments? That's a different conversation. I do think it's important to keep track of this, but I just log into my online portal. I see what my loan balance is. I keep track of, like, okay, I borrowed this much for, for purchasing my vehicle. I borrowed this much for flipping the heavy equipment. Just do a quick Google spreadsheet. Those familiar with life insurance company administration systems, especially those designed to administer whole life policies, know they are not built to track a volume of transactions. Okay, but I don't think that's, again, what does that have to do with infinite banking? Just set up a quick Google spreadsheet. That's literally all you have to do. Essentially, the more policyholder transacts with a whole life policy, the more blind they will become to their current position. So I guess he's talking about just not keeping track of the policy loan and what you borrowed it for, whatnot. Again, just log into your online portal and you'll see it. All right, interest rate assessments, surrender charges, loan repayment, blah, 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 is in danger of lapsing. The only time a whole life policy is in danger of lapsing is if you don't manage the policy loan. Make sure you're at least paying the interest every single year while you're implementing the infinite banking concept. When you're taking, if you're going to be using it for tax-free retirement income later, that's a different story, where you don't pay the policy loan back. The death benefit is going to cover it when you pass away. But yeah, when it comes to infinite banking, there's no danger of it lapsing as long as you're paying back your policy loan. You thought ATM fees were bad? Perhaps most revealing about infinite banking scheme. Look at that. Another really good word there is that it is not a strategy promoted by life insurance companies, but mainly by a lower tier subset of producers. Wow. So now we're going down to the personal level here, huh? Okay, good for you. Very productive. It's not necessarily promoted by like infinite banking itself is not necessarily promoted by life insurance companies. The two I work with are totally cool with it. I've spoken to multiple people within the companies I work with talking about infinite banking and utilizing the policies to build wealth. They even provide training on how to use the policy for that. Talking about or like designing it really, not like talking about how to do infinite banking, but it's more like designing the policy for high cash value and stuff like that, so you can access it for whatever you need. And then there's some companies that shy away from it. I think it's he says Mass Mutual told its producers not to position life insurance as check-in savings retirement vehicle. So I'm not going to argue against that. I get it. There's some pretty crazy stuff out there. You got to be careful how you promote these things, but again, what does that have to do with infinite banking? It may be that the life insurance industry will need to fund a TikTok campaign. Okay, yeah. That's it. Okay, good stuff. So anyways, I hope that was helpful, guys. I have a problem with these types of things where there was nothing really useful in that article to help make a decision about infinite banking. I didn't see anything bad about it that couldn't very easily be addressed. And that's what I have the issue with, guys. I just want you to have the information that you need to make the best decision for yourself based on your goals, based on your situation. Infinite banking can be an incredibly powerful financial strategy when you do it right, when you use the right vehicle, whole life, not IUL. All right. So, there's a lot of stuff you have to be careful with, right? You want to make sure you're in a position to actually implement this concept. But is infinite banking bad? Maybe for some people, but infinite banking itself is not bad. It's just a strategy. That's it. It comes down to how you use it. Just like anything else. Like if you were to trade the stock market, if you lose a bunch of money in the stock market, is the stock market bad? No, it's just the stock market. It depends on what you do with it. Same thing with real estate, same thing with any other financial product. All right. So you got to make the best decision for yourself. Anyways, that's it, guys. Last video here in the Life 180 studio. It has been an awesome trip. It's been so much fun. I can't wait to share release all of the content that we've been creating. It is freaking awesome, guys. I cannot wait for the next, just to see what this grows into over the next 12 months and how it impacts people and, bringing people on board and stuff and setting up these policies. Just like there's so much life-changing stuff within this type of what am I trying to say? Within infinite banking, dividend paying, whole life insurance, et cetera, whatever. All right. I'm going to wrap up there. I'm ranting. Hope you guys are crushing it. And I will talk to you in the next one. Matty Ice is out.